All right, folks, welcome to chapter 3. In chapter 2, I realized the mic is kind of weird. Let's hope that is fixed in this one. Give me feedback in the chat. And for those who haven't joined the chat, I sent the link for a couple of hours and I deleted it. I will resend it right now in the private group. Join, and I will remove it again because I didn't want to, and I'm still considering removing it if I see misuse. All right, so you don't need the chat, and I don't recommend the chat to you if you are easily distracted. But if you want to, then I'll post it for a couple hours. Chapter 3, time-based models, an introduction. In this lecture, I'll be covering two things. What is a time-based model, and what are the components of building a time-based model? Number one, which is what is a time-based model? It is a model which depends first on a time window, a specific time window to operate within, then on reading price within that time window. So you're basically mastering one specific predetermined period of time. This can apply to a specific monthly candle of the year, a specific weekly candle of the month, a specific daily candle of the week, a specific hourly candle of the day, etc. It can be applied to a specific season of the year. It can be applied to a specific data range of a couple of months within the year, and so on. To master a time-based model is to pick one of the aforementioned scenarios, one of these four, or the ones I mentioned which are not written, and master them with perfection, hitting the model and building it from all angles. Some of you have more time to spare for the charts. You're either a student in a useless degree, some art, something, gender studies, or you have no job, or you have a job which gives you more time. To those people who are not like me, I'm a extremely busy person. As you know, I'm a medical professional. I have my family, I have my other businesses. So I don't have enough time, or as much time as some other people do. For those who do have the time, trading every single trading session is also a time-based model. Any trading is time-based trading as long as there's a moving chart which is not frozen because it's the weekend or holiday. Then you are trading a time-based chart, whether you know it or you don't. So it's better to be informed because it's going to happen regardless. This is a look at the daily candle beyond the so-called kill zones. The daily candle has 6 4-hour candles, hence the importance of the numbers 159, 159. And this is something I've hinted at before and I've spoken about in the previous private group, which was level 2, Time and Turtle Soup, which you can find on the website. Link in the Twitter bio. I would really recommend that for those who want a full understanding, including this one. Now the plug aside, 159, 159 is what shapes the daily candle. Once you realize this, you realize that kill zones are customizable, right? You can curate your own kill zones once you understand this image. As soon as you understand what this means, then you've already made progress, and a lot of progress, in understanding the open, high, low, and close, more than the average Twitter follower or the even some of the public group members, most of them, you've advanced over them as soon as you understand this image. So there is some progress simply by looking at this. Simply by knowing this information, you have an edge. How you use it is what will transform this into money. Because that is why we're all in the markets, isn't it? Of course, in this teaching, I'm solely talking about demo money for legal purposes. A favorite non-conventional kill zone of mine is the 5 p.m. Yes, the 5 p.m. New York time. And I will leave that for your studies. There are 10 very high quality day trades per week. That is 2 per day, 5 days a week. These are the ones I'm mostly entering, and if you reverse engineer my entries, which some of you have successfully, and I congratulate you. If you are my mentee and you're spending time reverse engineering all my turtle soups, then you already have advanced over 90% of the followers and members. Which there are 25 good quality day trades per week. 159, 15. I'm hesitant to say 9 p.m. because it's usually consolidation, right? As we know, the markets spend 70% of the time in a consolidation and 30% of the time is not. So this gives you an encapsulation of the data, right? This is a form of collecting data. You know exactly when you're going to trade, which is twice a day, 1 and 9. If you have more time, then you can go and trade every single 4-hour candle. Likewise, there are 2 very high quality short-term trades per week. Once at the low of the week, once at the high of the week. As a general rule of thumb, the low of the week will form Monday, Tuesday, Wednesday. That's trade number 1. And the opposing end of the weekly range will be capped on Thursday, Friday. Trade number 2. With this information and this image, you can think outside the box and create your own weekly profiles. For example, Monday low of the week profile. This image is not random. For the astute observer, you will realize that this is a chart of Euro USD a couple of weeks ago. And I had come here on Twitter and said, I'm scooping up some Euro. All right, that was a Monday low of the week. And it never saw a decline after that. Why? That's your homework. Think, when does the high of the week form on Monday instead of Wednesday, instead of Tuesday, for example? But to encapsulate the weekly candle, you can be sure that it's going to be made, the low of the week is going to be made on Monday, Tuesday, or Wednesday. And the range will be capped on Thursday or Friday. And another thing is, the same candle, for example, let's take Wednesday. Wednesday cannot form the high and the low of the week. And that is my encouragement for you to think outside the box. Don't just look at this information and memorize it. Dissect it. Each word. Nothing is random. Nothing is placed randomly. Everything is deliberate. Once you understand that every day is a new opportunity, when I say day, I mean true day, which is the New York time, then FOMO ceases to exist. Because every midnight New York time is the birth of a new opportunity. Apply this concept with the fractal nature of time and price in mind to watch your win rate skyrocket. Truly, because if you missed a move, then you can simply align yourself with the next midnight New York time and watch a sense of calm take over your trading career. Why? Because every single setup you will take is timed beforehand. And this is one way of doing it. Once you truly digest this information, you will view trade setups as buses. If you miss one or you miscalculate one, then simply wait for the next. A common mistake is revenge trading because you missed one. Or FOMO. There is no FOMO. 159 will never change. So you have no excuse and no reason to FOMO. To relax, mark your levels, get a cup of coffee. If it hits the level, fine. If it doesn't, study why. Catch you next time. Understanding the bus stop analogy is your edge against uninformed dumb money. I'm pretty sure most of you, this is the first time thinking of price in this way, as every midnight is a new opportunity, either for a reversal or continuation or a scalp or whatever. Midnight New York is your key. And every midnight is a new opportunity. Every 159 is a new opportunity. And this includes ICT students who trade patterns, which is pretty much every single one on Twitter. That's one point. The other point is, what are the components that help build a time-based model? Your progress, you, the person listening right now, your progress is going to be divided and it's going to happen in 2 stages. And most people never make it past stage 1. Or they reach stage 2 and they get lazy, complacent, and they hop on to the next strategy. And that is not my goal with this group. My goal is not to have a bunch of strategy hoppers who came here because of the hype. Nope. Of course, I can't force you, but I can remind you. I can gently push you in the right direction. I can help you walk. I can hold your hand. I can walk slowly with you. But eventually, you're going to have to do something by yourself. You're going to have to... For improvement to happen, there has to be a will. Both a will to improve and a will to take action. Stage 1 is picking a specific time frame. And then picking a specific time of the time frame selected. Time of day, day of week, week of month, specific weeks, specific hours, specific days, etc. And then getting 2 sets of data. Back-tested data of at least 1 year, ideally 5-10 years, the more the merrier. I have some concepts, and this is an important part of understanding your edge, is crunching the numbers. I have some numbers crunched back 40, 50 years, even more. So when I see someone being too lazy to even back this to 1 year, it's astonishing to me. And successfully forward tested data of at least 3 to 6 months. And this is where the importance of lower time frame practice comes in mind. And this is the data, the forward testing, which will ready you for live market conditions. Once you obtain the aforementioned sets of data, stage 1 is complete. And you move on to stage 2, which is forward testing the model you have for 3 to 6 months. And once you find favorable results, you are 50% done. This should be 49 because the remaining 51% depends on you, the trader. A lot of you will watch this, and I know a lot of you will gloss over this part, but it is the most important part. Everyone has information. If you want information, information is ready and available for you, both free and paid. If you paid and you decide here, then you're trying to get better information. But there is free information, right? So there is no lack of information. If there is no lack of information, then why are 95% losing? The answer is because the edge is in the trader, not in the strategy. You are the edge. If you have the wisdom to select the correct mentor, that's an edge. If you have the wisdom to stick to him, regardless of his tone, because a lot of gifted people, they are usually hard to deal with, I've noticed. Including ICT, for example. Let's take him as an example. He's he rants a lot, right? Something I might not have taken from him. But if you can pick a successful mentor and try and emulate them, then you're better off than 95% of traders, because what they do is go from one mentor to another mentor to one strategy to another strategy. If you can dig your heels in the sand and really refine and force improvement, then there is no other way but improvement. You are the edge, but only if you choose to be. And that concludes chapter number 3. I wish you good luck, good studying, good trading, and see you in the next one.